Hello YouTube and After Hour. I'm back with another video on the covered call series, and this time we're going to be talking about the top mistakes people make when messing around with the wheel. And these aren't the worst thing that you can do, but try to avoid them at all costs. Number one, we're going to be talking about liquidity. If you don't know what liquidity is, I've got an example on the screen for you where we talk about the most popular thing that anyone trades, SPY, or as probably everybody calls it in their head, SPY. SPY is an ETF, so not an individual stock. So there'll be other things that you want to keep in mind when you trade this versus other stocks. We'll get to that in a bit. That tracks the overall S&P 500 performance, right? So all of the stocks that make up the S&P 500 are represented in SPY. Now, there are other ETFs that you can use like VOO, which is a Vanguard equivalent ETF, but they don't have the liquidity that SPY has. And we're going to go through that example right now. Now, if you look, I've got on the screen here a chart that shows the various options that you can buy right now. And maybe by right now, I should click the refresh button here so you see it's right now. So the current value of SPY is 570.69. Nice. If we're looking at what options that we might want to purchase, we're going to be looking at things that are, these, by the way, these are all calls. So we're going to be looking at calls that are typically at the money or above, meaning higher. And if we look at the current value, you'll see there's a lot of action happening right here at the 570 level where we're at. That means that there's a lot of people thinking that, no, this isn't going to go in one direction or another. And there's a lot of volume here, right? There's almost 150,000 orders that are open right now. There's 150,000 orders that are moving. Now, there's open interest of 8,000, and you can see that there's a lot of interest at other levels that are higher than this. So there's a lot of open interest if we go down to 575, which is a big round-ish number. Not even, but round. And people use that as a target point. So you'll notice that very often these numbers that end in a 5 or a 0 tend to have more interest than some of these other numbers, especially if you go out further. You'll see that, hey, okay, 575 is 15K, and the interest drops at 76, 77, 78, 79, and then back up at 80. And that's because we're always looking for these round numbers to hit or break through as we get through the different points of mental support that the different stocks may have. Now, that's not always true. It's kind of just like a rule of thumb. And you'll see that, why is 577 a popular point between 76, 78, and 79? Well, it probably is a past support level if we were to look at, the chart instead. And you'll see that 577 could be a support range, either the breakthrough point here, as these two bars touched it but weren't able to get through it, versus these two bars trying to drop it. We're not going to get into technical analysis right now today, but those things can tie into each other of, okay, support levels, resistance levels, they may have more interest around them. Whether or not you believe in TA doesn't really matter. It's something that some people do, and so you will see sentiment or order placement essentially around those points. But not really what we're looking to get into today. We're just really looking at volume. So conversely, if we look at VOO as an example, we'll see that, okay, there's a whole lot less volume. If I go back actually to SPY, I should have done this briefly before switching to VOO, you'll see that the volume is 12 million, right? So far today, where VOO is going to show conversely 1.2 million. So 1/10 of what SPY has, VOO has. And because of that, you'll notice that VOO does not have dailies. In fact, they have weeklies only, and monthlies and all that, of course, but they don't have dailies. You need a higher volume in order to support daily option trading. And VOO, as an example, you can see that, okay, this is where it starts mattering in terms of there's no volume at 540. There's some open interest, but there's no volume. You may not get filled if you put an order in. Why does this matter? Well, real simply, once you have an order in, if you want to buy it back at a price, if there's no buyers, you're not going to get it. Whereas SPY, on the other hand, pretty much any price that you pick within reason, right? Things that are not wildly out of the money. As the price changes, you're going to get pretty immediate fills. And you'll see that when you place your fills, basically once a level is hit in an options premium price, it's going to get filled. And that's the nice thing that you've got to remember. Now, it gets even worse if you were to look at something like RXRX, which is a stock that I like to follow, and it's popular on After Hour. The volumes drop significantly as you start looking at, individual stocks. And we're going to pick a weird date. We're going to look at May 2nd, which is not a common date to look at. Or maybe worse, April 25th, right after the third Friday, you start seeing these numbers that are in the single digits, right? So if you're trying to sell calls at $8, good luck. You might actually have better than what the bid is, but you might not be able to fill it because there's no interest. So that is something that you always want to keep in mind when you're looking at options is, what stocks are you trading and do they have good volume? Because if they don't, they may not get filled. And then you're stuck there going like, I did everything right. Well, no, you didn't, because you're messing with things that have no volume. So you do want to play with things that do have volume. Hopefully those align with things that you like and things that other people like. Number 2 mistake that people make is ignoring catalysts, right? So if we were to look at earnings for RXRX that we currently have on the screen here, they have a big date estimated on May 7th. So your options are going to be wildly different between May 2nd and May 9th if that earnings is a confirmed date. Now, I will say Fidelity doesn't always know the exact day. Sometimes they estimate it as they did here, and this may not be meaningful, but there could be other things that you want to keep into consideration, and you would look at the news to make sure that you're keeping those things in consideration. So if we were to look at RXRX, I don't see anything off the top of my head that is huge other than, a downgrade on the 24th a few days ago. That's probably already priced in. However, things like NVIDIA, right? If we were to look at NVIDIA, which has a lot of action on it typically, they recently had the conference, right? So the conference might be something that very heavily affects either NVIDIA or other stocks and sectors that are tied to it. So for example, the quantum sector, which got hit really hard, and I've talked about this a few times, from NVIDIA saying like, they're 10 to 20 years out. Well, they were in the NVIDIA conference, and what happened there was a huge run-up, and with that, things like IV, implied volatility, are going to increase, premiums are going to increase. So you want to be aware of what you're trading around, because that can really mess with your plan. So number 2, ignoring catalysts is a dangerous thing to do. Number 3 gets into chasing premiums. And here we're going to look at option charts that show the highest implied volatility, sorted by implied volatility companies that you can buy right now today. And there's some big ones. There's like Nikola, which I believe is going bankrupt or might go bankrupt. There's Beyond Meat, which has been in the news repeatedly for just being all over the place. Qubit, personal one that hurts me to say that I chased this one before the NVIDIA announcement of them being 10 to 20 years out of having any profit. BBAI, which we'll talk about here in a bit, another one that has a lot of volatility around it. And if you mess with these, you can get burned. And I can talk about this from personal experience with Qubit, where I knew it had high implied volatility. I thought there was a channel, and sometimes you're wrong. Sometimes you can't have any control over a black swan event like Jensen Huang telling you that, hey, quantum is never going to happen. It's 10, 20 years out. Okay, well, guess what? They ate it bigly. And now I'm kind of stuck with it for a while, either bag holding or selling it at a loss. But the fact is, because it still has such high implied volatility, it still has good premiums, and I'm still selling cover calls on it. But you've got to be careful. And what it really means is you're gambling a little bit. You've got to be aware of that and take that into consideration when making those plays. Number 4, holding to expiration. I've got a little chart here that shows Hood as an example. And this is, the Hood price is live. but the strike and premium are probably slightly off now since the time that I put this together. Doesn't matter. If we look at the ticker hood, we'll see that the price is 45 bucks. And if we were to look at the expiration date of the 17th of April, that's 21 days to expiration. When I checked, you could, at a $46 strike, you could have bought or sold these options for $269, and that's great. Okay, that's cool. That means for every $4,500 that you've put up, you're earning $269 over the course of that 21-day expiration. Now, you can hold that to expiration, or you can buy it back if you get to a point where before 10 days, you can buy it back for better than 50% profit, which would mean that the premium would have dropped to $1.35, which is half of 269-ish, or better. Better being lower than 135. So what my recommendation is, immediately after you place your trade, you place a limit buy. Again, this is on the selling option side. So the minute after you sell an option successfully, get it filled, put in a limit buy. 60 days out, whatever, good to close. Track it, of course, but make sure that you put one in for 50% or better. Sometimes you can get away with, like, if you know it's very volatile, and there's a lot going on with Hood right now, you could probably get away with changing that to $1, and it might hit. So if you want to be greedy, you can be greedy. If you want to be, I would call it disciplined and conservative, put it at 50%. And if you hit that in the first 5 days, congratulations. You've made a better annualized return on that money than if you had waited to expiration. So your money is now freed up again, which is essentially a form of cash flow, right? Because you can redeploy that money in a profitable way, more profitable, hopefully, than what you've got there. Or you can repeat that same exact trade repeatedly, which is an amazing thing, because I've done this with Reddit before, where you can sell an option. I buy it back for 50%, sometimes the next day, because some of these stocks are so volatile. And then a day or two later, sell it back for that same original price and buy it back again, all before it ever expired. So that's a way to supercharge the wheel and really get better returns than you would get if you held it to expiration. Number 6 is impatience. And impatience can really bite you. If we look at an example here of lunar or intuitive machines where they're trying to land on the moon, which is pretty cool. Actually, maybe try is not the right word, did successfully, although sideways, so semi-successfully, land on the moon. You can look at this chart and very clearly go like, oh, there are times where you should sell a CC or should sell CSP, or maybe not do either. And as an example, this is just the last 6 months. If we were to look at where we're at today, I would be very hesitant if I was a stock owner of this stock, which I'm not. I wouldn't be selling CCs on this quite yet. I would have a little bit of patience to see where things go. If we were to look at, the 1 month, are we in a channel now, a new channel between, say, 7 and 9? Maybe. So maybe you could sell a CC if you're pretty covered call. Of course, if you're very confident that no, this is going to stay in this range and I can sell it while not worrying about assignment, unless you want assignment, of course. Or it maybe more appropriately, we should be looking at selling cash secured puts here, because we're at not an all-time low, but within the last 3 months-ish, 2 to 3 months low, right? So that could be a good time to sell cash secured puts, especially if you go back all the way 6 months. We're actually at a 6-month low in this point as well. Now, covered calls, on the other hand, you would have want to be selling these here or here, because we don't know, right? We don't know what the future is going to hold. So as things are spiking up here, you would be considering like, oh, have we reached a top? Are we at a point where now is a good time to sell a covered call? Now, Lunar's a little memey. I no offense to those who love Lunar. I'm not saying it's a bad company, but it's clearly very volatile with a range from $8 to $22, or maybe more accurately, $3 to $24 if we're looking at the past year. That's a lot of movement in just a year. So you've got to be careful with the plays that you make on that type of stock. Alternatively, we could look at something like Walmart, and Walmart tends to be a little bit more stable. However, if you look at the last month, again, you might be saying, I own the shares. Maybe I should sell covered calls. Maybe, but if you go back 6 months, man, it would be a little painful if you sold covered calls for like 90 and then got assigned because the stock decided to go back to 95, right? You would get assigned in that situation. So always look at where you're at in time, and it's okay to have a little patience. You don't need to make a trade every day with the wheel. You've got to be considering, is this the right part of the cycle? And depending on where the cycle is, you want to have ideally some cash available to take advantage of the cash secured put side, or ready to let some stocks fly on the covered call side. That's how you make money. Finally, number 7. Yes, we got up to 7 here. Awesome. We're going to be talking about another stock that I've owned and currently own, which is BBAI. And I'm not suggesting you buy it. This is not financial advice, as I've said a million times here. But what I will tell you is there are times where people are so scared of assignment, they choose to do nothing. Now, if you owned BBAI up here, you might be very hesitant to sell covered calls, and I get it. And I know I just said have patience, right? But as new channels develop and you start ignoring long ago history, which in this case is just 2 weeks in my example, so maybe don't always listen to this, right? Find the right timing for this to make sense. But if you were to look at this, you could have sold covered calls here. And I did. And I got assigned at it was 353 when I closed, and I got assigned at 353. Well, 350. So I lost 3 cents on the shares that got sold. However, I immediately put a limit order in to buy it back. And when I did, I put the limited order in for like 340 or 330. It was in this range, right? Well, look what happened on Monday. On Monday, the volatile stock, which we just looked is on this chart here, right here, of highly volatile stocks, decided to drop all the way back down to under 3, a couple of times actually. So when my limit got hit, it actually didn't fill until 312. I think that was the top of this candle, right? That's me here at 312, somewhere in this range. I got assigned at 312, which translated into a net credit if you look at what you sold by, what you bought it back by, and then what you could sell it again at, right? So obviously there's some timing the market here type stuff that you've got to be careful about. But just because you got assigned doesn't mean the stock's only ever going to go up or only ever going to go down from here. It's choppy. It's often choppy. Most stocks are choppy for, I don't know, the entirety of where they are, right? So maybe you got assigned here. That's fine. Got assigned at $5. Guess what? Bought it back at 3. Okay, not likely. More likely you bought it back at like 450 or whatever. Obviously, this depends on the stock that you're messing around with, and this is just an extreme example of what can happen. But more importantly than that is don't always fear assignment. Assignment isn't the end of the world. Now, yes, you want to be careful if it's in a taxable account versus a retirement account. A retirement account will allow you to get assigned without having to worry about taxable events until you sell it down the line. But with that in mind, you can play that game a little bit where you can maybe go a little bit closer to the money, at the money, in the money potentially, depending on how you feel about the stock, and cash in on that, right? So always consider that you don't need to always try to sell far above your cost basis to make the most, because the fact is the premiums are going to be much lower there as that's priced in. So instead, consider where you think the stock currently sits, right? What that channel might be, which BBAI is kind of interesting because it has what looks like clear channel right now, anywhere between 290 and 375. That's a really big range, by the way. It doesn't look it here, I know, but as you zoom in, I mean, that's a big range, right? That's 25% stock movement percentage-wise from here to here. So always keep in mind what the equity is that you're looking at so that you can make the best possible decisions. So always keep in mind what the individual stock you're looking at is doing, because assignment might not be that big of a deal. And while it's good to be patient, not doing anything for months at a time is also probably not the answer if your goal is to generate income by selling options. It could be, but it's probably not. So that's all I've got for you. Those are some lessons that I've learned over the years of selling options, and I certainly hope that this video helped you think about it differently. Again, this isn't financial advice. You always need to make sure you're doing your own due diligence and you've got a thesis before you enter in any trade. All I'm really sharing today are things that you might consider when entering in those trades, maybe a little bit differently than you would have yesterday. Thanks for watching, and I'll see you in the next video.